Good morning, everyone. So as you may know, in the past year or so, ASC, CSA, and CERO staff have worked on sweep reviews to examine how firms are complying with the new CFR requirements for KYC, KYP, and suitability. We wrapped up our fieldwork for this sweep around the fall of last year. All final letters have been issued, and most reviews have been completed. While compliance deficiencies were identified, we noted that firms we examined generally demonstrated that they made reasonable efforts to operationalize their processes to comply with CFR requirements. James and I's intent of this presentation is to go over the CFR requirements with regards to KYP, KYC, and suitability in the context of the summary of our findings. As Matt mentioned, we understand that every registrant has a different business model, but by going over these findings, we hope you get a better understanding of the requirements and perhaps use the guidance and best practices we've seen when applying the CFRs to your own business and compliance structure. Okay, so under the KYC obligations, we want to share with you these three issues. Generally, we noted that most firms had processes in place to collect and periodically update KYC information. However, we noted firms may not have considered the specific post-CFR requirements. We'll then move on to KYP obligations and share with you these four issues. I'd like to mention that while the KYP requirements in the CFRs are new additions to 31103, the KYP processes were previously part of an implicit requirement supporting suitability determinations. We noted that firms have taken a range of different approaches to carrying out their KYP obligations that are appropriate for their specific business models, such as performing all firm-level KYP obligations at their head office, or delegating certain assessments and approval obligations to registered individuals or committees. For example, many PM firms have a specialized group of advising representatives who perform KYP on specific securities that are to be included in model portfolios, and then client-facing ARs are only responsible for performing KYP on the model portfolios themselves, rather than each security within the model. And finally, we'll end with the suitability determination and discuss these five issues. We acknowledge that not all suitability factors will be relevant to the same extent, depending on the type of account and products offered and the client's particular circumstances, and the investment action being considered. Registrants must use their professional judgment in the circumstances and take reasonable steps to consider each of the factors and whether and how they are relevant to the specific investment action being considered. So, when James and I were drafting this presentation, we realized that our speaking notes stated putting the client's interest first a ton of times. So we took this statement out of most of this presentation, just to try and avoid sounding like we're repeating ourselves over and over. However, with that being said, the overarching theme of the CFRs is to prioritize client interest in all interactions. For this presentation, this means suitability determinations, given the collection of KYC information, and the KYP assessment must be made to support investment actions that always put the client's interest first. Okay, so we noted that some registrants had not updated their KYC processes post-CFRs to determine their client's risk profile, including collecting and considering information regarding both risk tolerance and risk capacity. Instead, those registrants collected and considered only information about their client's risk tolerance. We also saw that some registrants had an adequate process to determine the client's risk profile, but did not maintain documentation to support that the client had confirmed the accuracy of the KYC information. So for example, we saw PM firms that only documented the client's risk profile in internal notes, but did not verify with the client that the client agreed with the accuracy of the firm's determination. So what can you do? Registrants must take reasonable steps to ensure that they have sufficient information about their clients to enable them to meet their suitability obligations. including having sufficient information regarding a client's risk profile, which is the client's combined willingness and capacity to take risk. For registrants to discharge this obligation, they should collect both risk tolerance and risk capacity information for each client and consider both elements to arrive at an overall risk profile for the client. Risk tolerance and risk capacity are separate considerations and should be assessed separately. A best practice is for the risk profile to be the lower of the two. However, we know some firms' determination of the risk profile is not based on the lower of the two, and that's okay, as long as it's reasonable and clearly supported. Risk profile is part of a client's KYC information, and like other KYC information, is required to be confirmed by the client. We noted that information about liquidity needs was not always collected for clients. As part of the suitability obligations, registrants need to understand if a portion of their clients' assets are required to meet expenses or obligations in the near term. This is especially important when clients are invested in securities that are generally illiquid or lack redemption features. We also observed some instances where registrants didn't collect net financial assets, net worth, or income information, or collected the information in a way that would not lead to a meaningful understanding of the client's financial circumstances. So for example, if a registrant collected net financial assets for a client as falling within a range of $500,000 to $1 million, a $200,000 investment in a security could represent anywhere from 20 to 40% of the client's net financial assets. We also noted that in some cases, when multiple family members have joint and individual accounts, the firm didn't collect sufficient KYC information from each of the individuals. For example, some firms collected annual income and net financial assets on only a combined basis for spouses, and as a result, would have insufficient KYC information to support their suitability determinations on individual accounts held by each spouse. So, fulsome information is needed for registrants to have an accurate understanding of their client's financial circumstances. Where there is reasonable doubt about the accuracy of information given by the client, the registrant should make further inquiries or obtain corroborating information about the client's financial circumstances. Registrants should also obtain a breakdown of financial assets to ensure a sufficient understanding of the client's financial circumstances. Okay, keeping KYC information current. So this is a big change to the requirements, at least around timelines, which are now quite prescriptive. So registrants must take reasonable steps to keep their clients' KYC information current, including updating the information within a reasonable time after the registrant becomes aware of a significant change in the client's information. In addition, the CFRs imposed the following prescribed minimum timelines by which registrants must review and, where applicable, update KYC information for clients. So for managed accounts, no less frequently than once every 12 months. If the registrant is an EMD, within 12 months before making a trade for the client, and in any other case, no less frequently than once every 36 months. A number of firms had some client files that did not have sufficient up-to-date KYC information to comply with these minimum frequencies. And these firms had no documentation showing they had taken appropriate steps to proactively contact the client to update KYC information. Some registrants explained to staff that they had met with clients within these time periods and that the KYC information had not changed, but did not have sufficient or any documentation to evidence that these meetings had occurred or what KYC information had been discussed. For example, we saw some client files which just had a note saying, "No change at this time," which is not sufficient to meet the requirements. And some registrants did not take reasonable steps to have clients confirm the accuracy of changes and updates to KYC information, including in situations where significant changes were made to the information. So what can you do? Registrants must be able to demonstrate that they have taken reasonable steps to keep their clients' KYC information current. Registrants must also review client KYC information and make any necessary updates at the required frequencies at a minimum, and more frequently if the registrant becomes aware of a significant change in the client's circumstances and KYC information. Registrants should maintain documentation of the KYC update conversations they had with clients, which should be dated and detailed enough to support that a meaningful interaction occurred and that all aspects of the KYC were reviewed and updated, even in instances when no changes needed to be made to the client's information. Registrants may use professional judgment to determine the level of detail needed in their documentation, but it is no longer sufficient for a registrant to simply note no update to KYC without any detail regarding what was actually discussed with the client. Client confirmation of the accuracy of KYC information collected or updated may be evidenced by obtaining the client's signature or by maintaining notes or other documentation like an email message in the client file. We all know that clients can sometimes be unresponsive. Where this is the case, registrants must maintain evidence of their reasonable attempts to contact clients to update the information. When KYC information may be stale, registrants should consider whether restrictions on the applicable client accounts are necessary until KYC information has been updated. We observed that some firms did not document any KYP assessment of securities of related or connected issuers, or maintained only limited documentation. In some cases, firms incorrectly assumed that their involvement at the issuer level was sufficient to demonstrate that they had met the KYP requirement without requiring any KYP documentation. Ashley will discuss the KYP requirements for related and connected issuers in her presentation, but what I want to say is that we don't expect firms to duplicate their duties and issuer level documentation. We also saw in some cases, although firms had documentation that stated that certain securities were approved to be made available to clients, there was insufficient evidence to demonstrate how that decision was reached. Documentation simply confirming approval for a particular security without anything supporting that decision is insufficient to satisfy the firm's KYP obligations. So, what can you do? A firm's KYP assessment process should align with its business model and the types of securities offered to clients, with the depth of assessment varying based on the structure, features, and risks of the security. Less complex and risky securities may require a less extensive review than those that are more complex and riskier. A firm's KYP assessment and approval process may reflect the division of responsibilities between the firm and its registered individuals, keeping in mind the requirement that registered individuals need to understand the securities offered or made available to the firm or at the firm. We saw a variety of different KYP assessments and documentation practices that comply with the CFRs in our reviews. So certain firms that focus primarily on proprietary products design their KYP assessment process to place a strong focus on risks in that business model, including in particular conflicts of interest and incorporating market comparisons with third-party products into their processes. PM firms that use technical or algorithmic models have set up tailored KYP processes that are specific to their models to enable them to conduct technical or algorithmic analysis of multiple securities and document how chosen securities meet the desired investment criteria for approval. These firms maintain documentation evidencing details of the models used and its explainability, and evidence that the firm had sufficient oversight of the model to ensure that it is functioning appropriately. Documentation of the approval should include evidence of a meaningful consideration by the individual or a group approving the security. Some examples of firms' specific KYP assessment and approval best practices observed in reviews included preparing and maintaining due diligence memo, research reports, or summaries for all securities made available to clients, including on securities of related and connected issuers, which also record the firm's approval of the product. Discussing key aspects and features of securities at investment committee meetings and maintaining detailed minutes or recordings, which also confirm that the committee approved the security that was discussed. Establishing a process where registered individuals identify and research securities with potential to be made available to clients, carry out and document the KYP assessment, and then bring that information to an investment committee for consideration and approval before making them available to clients. In cases where firms specialize in certain sectors, greater reliance can be placed on the KYP assessment completed and documented by registered individuals who have the necessary expertise, and approval is then often granted by a supervisor or chief compliance officer based on a review of that KYP analysis prepared. Okay, and then last for me, staff also noted some instances where firms used model portfolios to invest client assets, and there was no evidence to demonstrate that the firm's registered individuals had taken reasonable steps to understand the model portfolio before recommending them to clients. So for client-facing registered individuals whose clients invest in model portfolios offered by the firm, the KYP obligation is for those registered individuals to take reasonable steps to understand how the model portfolio are composed, their features, risks, and who they would be suitable for. An analogy would be that the model portfolio should be considered as a notional investment fund when performing this level of KYP assessment. I'll now turn over the presentation to James to finish.
Thank you, Adam. I will continue our presentation on the KYP findings. There were some firms identified in our reviews that had no process to monitor securities for significant changes. This requirement applies to securities that are available to clients and securities that are held in client accounts managed or advised by the firm. In addition, some firms that offered model portfolios to their clients did not have a monitoring process in place to identify whether any changes to those model portfolios constituted significant changes that could affect suitability. There were also some firms that received or obtained up-to-date information on securities made available to clients, but did not also maintain evidence that they reviewed and considered this information as part of their monitoring process. For example, it is not sufficient to obtain updated financial information for issuers without completing a KYP review of this information. What constitutes a significant change to a security may vary depending on the type of security, the business model of the registered firm, and investment strategy employed. Some examples of significant changes that firms have identified included changes in the risk rating of a security, the liquidity of a security, the operations of an issuer, management or ownership of an issuer's credit rating, financial ratios, the geopolitical situation, and macroeconomic factors. Firms are responsible for determining how and at what frequency they will monitor the securities they make available to clients. As a security's risk and potential for significant changes increase, the more frequent the monitoring should be. In general, staff did not find it adequate for firms to only conduct monitoring on an annual basis. Where significant changes have been identified, firms should document their KYP assessment of those changes and their consideration of whether any further action needs to be taken in response to the changes. Depending on the extent of the change to a security, actions taken by firms may include notifying registered individuals of the change, reassessing suitability for clients, taking corrective actions in client accounts where necessary, revisiting the firm's approval of the security, and implementing additional controls around the sale of the security. We noted that in some cases, for example, for EMDs, because of the nature of the securities held by clients, such as illiquid securities or securities with restricted redemption, firms reviewed were limited in taking corrective action in response to a significant change to those securities, such as a major change to distribution and redemption features. In these cases, we noted appropriate responses by firms included stopping new distributions of the security and reporting the nature of the significant change to clients that held the security, given that in the circumstances, there was no other corrective action that could be taken. Some examples of firms monitoring processes that were best practices included updating due diligence memos or redoing the key elements of the KYP assessment on a periodic basis to identify any significant changes, informing all registered individuals of any significant changes and retaining all versions of these documents to evidence the process, and creating a tailored watch list or approve list in their portfolio management software so that on a daily basis, key metrics and news stories about the issuers are provided to registered individuals whose clients have invested in these issuers so that they can review securities for significant changes. We observed that many firms and registered individuals did not perform and document KYP assessments at all or within a reasonable time on securities transferred in from other registrants or on securities resulting from client-directed trades. We also observed that some firms had inappropriately excluded securities transferred in or resulting from client-directed trades from their KYP processes based on defined thresholds. For example, if the firm considered that the amount of the trade was not sufficiently significant to warrant a KYP assessment, or if such trades were infrequent. Although registrants are required to assess all securities transferred into the firm or that result from client-directed trades within a reasonable time after the transfer or trade, we recognize that the depth of the KYP assessment may vary depending on the circumstances, including the nature of the securities and the length of time that they will be held in the client account, the client's circumstances and investment objectives, and the relationship between the client and the firm. However, firms must not completely exclude these securities from their KYP assessment and monitoring processes. The level of KYP assessment that the firm and registered individual perform should be sufficient to perform a suitability determination, including with regards to a recommendation to continue or hold or reduce the securities. As a best practice, we noted on our reviews that some firms required registered individuals to submit their documented KYP assessment to a supervisor or CCO as proof of having conducted an adequate assessment on securities transferred in. Moving on, let's begin our discussion on suitability. Some firms did not recognize that suitability determinations need to be performed for model portfolios made available to clients at different levels. At the model level, where securities are selected for the model portfolios, and at the client-facing level, when a model portfolio is selected for a client. Registrants must appropriately document their suitability determinations for investment actions taken for clients to demonstrate that meaningful assessments have been completed and that they support the actions taken. We recognize that depending on the particular circumstances, such as the firm's business model, types of securities made available to clients, and the investment action being considered, some factors in the suitability assessment might be more relevant than others. If a factor would not be relevant, for example, when the securities involved in the assessment do not have any embedded costs or fees, such as when a firm only recommends stocks, the registrant should have a process to document why an assessment of fees is not relevant. In these cases, this explanation is not required in each suitability determination, provided that the firm has established an adequate firm-level process and policies supporting the lack of relevancy of a specific factor for all its suitability determinations for these specific types of securities. Where an investment action may appear to be inconsistent with a factor, such as when an investor with a high-risk profile and growth investment objective purchases a fixed income security, but there are competing considerations that make the investment action ultimately suitable for the client and one that puts the client's interest first, thorough documentation should be maintained to explain the determination made by the registrant. With regards to model portfolios, the suitability process for securities within model portfolios can be done as part of the KYP assessment of potential securities to be included in the portfolio, but it has to be performed and documented by the firm. At the client level, it is the responsibility of the client-facing registered individuals to perform a suitability determination on the model portfolio itself when selecting a model portfolio for clients among the options made available by the firm. As part of determining whether a particular investment action would be suitable for a client and put the client's interest first, registrants are required to consider the impact that the action would have on the client's account, including the concentration of securities within the account and the liquidity of those securities. In addition, the registrant must consider the impact that the investment action would have on the concentration and liquidity of a client's investments across all accounts held at the firm. In our reviews, we saw that some firms did not have thresholds or limits in place for clients with respect to liquidity or with respect to the concentration of types of investments, issuers, sectors, and asset classes. This included firms such as EMDs selling very concentrated or liquid investments, and these EMDs did not have thresholds in place to assess the overall exposures that clients have to such investments, whether through investments held within or outside of the firm. Some firms lacked adequate controls to consider concentration and liquidity across multiple client accounts at the firm. In addition, we noted that some firms that strategically invest certain categories of securities in specific types of accounts, such as when interest-paying securities are held in registered accounts for tax planning purposes, lack documentation to demonstrate the concentration and liquidity assessment to support the specific account allocation. Some EMD firms did not collect adequate information about investments held by their clients outside of the firm, including exempt market or liquid investments, which led to the firm being unable to adequately assess the impact of a proposed trade on the level of liquidity and concentration of the client's financial assets with respect to investments in exempt products or a particular sector or asset class. For some EMDs or other registrants with narrow or specialized offerings that are generally comprised of higher risk and illiquid securities, the controls required will involve obtaining a thorough understanding of a client's financial circumstances and specifically financial assets held outside of the firm. We acknowledge that some clients may refuse to fully provide the necessary information. In these instances, registrants must use their professional judgment to consider whether they have obtained sufficient KYC information on the client's financial circumstances to meet their suitability determination obligations in the circumstances in respect of the concentration and liquidity and otherwise, or whether they should decline to provide the securities to those clients. Some firms have implemented best practices with appropriate concentration and liquidity thresholds, and they monitor accounts and portfolios for metrics such as percentage exposure to an issuer, asset class, and sector, and these firms assess those metrics against thresholds when considering whether a new distribution of a security would be suitable for a client and put the client's interest first. These firms document their analysis as part of their suitability determination documentation for each distribution. In addition, some EMDs have implemented variable concentration and liquidity thresholds that are applied more conservatively to certain types of investors, such as investors with lower risk tolerance and seniors. Some PM firms use portfolio management systems to consolidate holdings across client accounts to enable registered individuals to meaningfully assess and monitor concentration and liquidity across multiple accounts held by the client at the firm. Issues relating to registrants' assessments of the potential and actual impact of costs noted in our reviews included firms where suitability assessments did not include how the registered individual considered the embedded fees and costs of products when recommending them or including them in client portfolios. For example, when an AR included a third-party ETF in a client portfolio, they did not document an evaluation of the cost of the ETF versus other potential suitable alternatives. Given that costs can have a significant impact on a client's return over time, a consideration of the relative costs of investment options available to clients and the impact of those costs is important when making a suitability determination. The extent to which certain costs are relevant in the suitability determination for an investment action may depend on the specific circumstances. For example, where registrants only invest in securities of certain types of issuers listed on an exchange, for instance, publicly traded stocks, the impact of costs may not be a significant factor in each individual suitability determination. given that the only applicable costs in this scenario are the trading costs, which would not vary among different investment options for the clients. In these specific cases, while firms are required to meet their best execution obligations when selecting a broker, staff do not expect detailed documentation of the registrant's consideration of costs at the level of each suitability determination. However, in cases where a security has other costs associated with it or embedded in it, such as management fees, trailers, administrative fees, these costs should be considered and documented in the suitability determination. In some of our reviews, registrants who have a shelf with multiple approved products were unable to show evidence that a reasonable range of alternatives available to the client at the firm was considered at the time an investment action was taken. When a firm has a limited product shelf, such as when it only sells proprietary products and clearly discloses the limitations and applicable conflicts of interest of this business model to clients, firms are not expected to consider alternatives outside their shelf at the time of each suitability determination, although this comparison may be done within KYP assessments, for example, as part of steps to address conflicts of interest arising from this business model. We also found that some firms did not consider a reasonable range of alternative actions available when selecting securities to be included in the model portfolios. There were also instances when registered individuals purchasing or recommending a particular model portfolio to clients did not document their consideration of the alternative model portfolios available through the firm that may have been appropriate and why the particular model portfolio was selected for the client over others available. For some PM firms, where investment decision-making for all clients was generally centralized, we saw that the reasonable range of alternatives was considered as part of the firm's KYP process. That is, these firms assessed and considered a reasonable range of alternatives when completing KYP assessments on securities being considered for client portfolios and maintained documentation sufficient to demonstrate their consideration of all alternatives at the firm level. Staff also observed certain PM business models where a centralized group at the firm prepared, on a periodic basis, a list of securities that are approved to be made available to clients, and registered individuals select securities from that approved list for clients. For these firms, registered individuals then document their assessment of how a particular security was selected from available alternatives on the approved list. Lastly, we found that some firms reviewed seem to be unaware that certain steps are to be followed and documentation maintained before accepting client-directed trades. The CFR requirements for client-directed trades set out that a firm must first complete a suitability determination. Then, if the investment is determined to be unsuitable, the registered individual must inform the client of this fact and make an alternative recommendation that is suitable, and only then, if the client still wishes to proceed, they must record confirmation of these instructions before proceeding. Some specific issues noted during the reviews included, firstly, no documentation to evidence a suitability determination for the proposed investment action. For client-directed trades, many registrants did not have any documentation to evidence that a suitability determination was performed and for the requested client-directed investment action. And secondly, inadequate suitability determination for the proposed investment action. In some instances, registrants performed a general suitability determination on the proposed investment action, but did not consider all of the suitability determination factors, including a consideration of a reasonable range of alternative actions. When an unsolicited client order or instruction is received, it is the registrant's obligation to first determine the suitability of the proposed investment action. And where it is not suitable or does not put the client interest first, the registrant must follow the steps set out in subsection 13.3, 2.1 of 31-103 and maintain appropriate documentation. In a circumstance where the proposed investment action is determined to be unsuitable for the client and the registrant determines that there is no suitable alternative action available to the client through the firm should communicate that their recommendation is to not make an investment. So these were some of the issues that we saw with regard to KYC, KYP, and suitability as part of our CFR sweep reviews in Alberta. The CSA, jointly with CIRO, will be publishing guidance in the fall. In the meantime, this presentation will be posted to our ASC website soon, and the FAQs with regards to CFRs are available to help you meet these new requirements.
My name is Ashley Lee. I am a senior regulatory analyst on the Registrant oversight team. Along with my colleague Claudine Sigua, we will be presenting on the findings from the compliance reviews that our team has conducted in the last year. During the last year, we continued to focus on portfolio management firms. Our compliance review also included investment fund managers. Today, we will be presenting an overview of the findings we have identified in our recent compliance reviews. Some of the common findings we have identified for the collection of KYC information during our compliance reviews are: some registrants are only confirming if a client is one of either a domestic politically exposed person or a foreign politically exposed person. Registrants are required by FINTRAC to establish if a client is a domestic and foreign politically exposed person. Some registrants are not adequately confirming and collecting sufficient information about the client's personal and financial circumstances. For example, for personal circumstances, some registrants did not confirm or collect the client's number of dependents, whether someone other than the client has financial interest in the account, and whether someone other than the client is authorized to provide instructions on the account. Some registrants are not taking reasonable steps to obtain the name and contact information of a trusted contact person with whom they may communicate with in specific circumstances. Registrants are not prevented from opening and maintaining a client account if the client refuses or fails to identify a TCP. However, they must still take reasonable steps to obtain the information as part of the KYC process for all clients who are individuals. In a situation where a client may have previously refused to provide TCP information, registrants should ask such clients if they would like to provide the information at each KYC update. Lastly, we found that some KYC forms are not signed by an advising representative responsible for the client's account or a firm representative, such as a CCO, after the file has been reviewed. The guidance in CSA Staff Notice 31336 states that registrants should sign and date the KYC information. Common finding during our compliance review is that the KYP assessment conducted by some registrants for the securities made available to clients did not consider all the relevant aspects and elements of the security. For example, we found that some registrants are not assessing the conflicts of interest inherent in the securities, the parties involved, for example, management of the issuer or portfolio manager, and the initial and ongoing costs of acquiring, owning, and disposing of the security, including the fees indirectly paid to the registrants or other parties. For example, commissions paid by the exempt market issuers to an EMD, and property management fees paid to an affiliate of the issuer. We also found that some registrants are not conducting a KYP assessment to evaluate the proprietary products. Registrants distributing proprietary products must conduct their own KYP assessment. Registrants distributing proprietary products must undertake their own product assessment, independent of any that may have been done by their affiliated issuer or by other individuals within the group of company. While duplication of duties and issuer-level documentation is not expected, registrants are required to perform a KYP assessment of the securities of related or connected issuers at the proprietary product level, particularly when the firm's client-facing registered individuals are not the same individuals who are involved in managing the issuer as a portfolio manager. Recent findings we have identified relating to suitability determinations are: some registrants are not considering all the required KYC information when making the suitability determination because the registrant did not collect sufficient KYC information about the client. For example, the registrant's suitability determination did not consider risk profile, including risk tolerance and risk capacity, net financial assets and net worth, or annual income, because the information was not collected from their client. Suitability cannot be determined without having first complied with the KYC and KYP obligations. Registrants are expected to gather sufficient information through the KYC process to support the suitability determination. We also found that some registrants are not assessing the impact of concentration and liquidity of securities on the client's account or portfolio, which was discussed in the last presentation. During reviews, we identified suitability concerns because we found that some clients' portfolios were not aligned with the client's KYC information. For example, there were a few clients whose risk profile was lower than the risk level of the portfolio. Specifically, we found that there were a few clients with a risk profile of low to medium. However, the clients' portfolios were mostly comprised of equities and high-risk alternative investments. In these cases, the advising representative in charge of the account did not have any suitability explanation on how this riskier asset allocation was suitable. Further, there were client portfolios that were not aligned with the client's investment policy statement. Specifically, the asset allocation in the client's portfolio did not align with the asset allocation targets in the investment policy statement, which raises suitability concerns because the portfolio may not be suitable for the client, and the client may not have agreed to the PM taking a different investment approach. We continue to see some registrants not performing a reassessment of suitability at the time of a triggering event. This became a rule from the CFR Amendments 231-103. A triggering event is when one of the following events occur. A new registered individual is designated as responsible for the client's account. The registrant becomes aware of a KYP change in a security in the client's account that could result in the security or account not satisfying the suitability obligation. The registrant becomes aware of a change in the client's KYC information that could result in the security or the client's account not satisfying the suitability obligation, or the registrant's periodic review of the client's KYC information. When one of these triggering events occur, registrants are generally required to reassess their original suitability determination. For example, one type of deficiency we saw was when there was a change in the client's KYC information, specifically that the registrant became aware of a change in the client's liquidity needs because of their upcoming retirement. However, the registrant did not reassess suitability even though a triggering event had occurred. In this case, we expected the registrant to make a new suitability determination for the holdings in the client's portfolio, as the client's personal and financial circumstances, investment needs and objectives, risk profile, and investment time horizon will change as the client is expecting to retire soon. Another common finding we have identified is that some registrants did not have sufficient documentation supporting their suitability determination. In some cases, the registrant provided staff with a suitability determination explanation that was done after the trade. More specifically, at the time of the ASC examination. However, this is inadequate as the registrant must maintain records to demonstrate compliance with the suitability obligations. Registrants are expected to maintain records documenting all relevant facts, including key assumptions, the scope of data considered, and the analysis performed in making each suitability determination at the time of the trade. Lastly, we found that for some firms, suitability determination is only conducted at the household level, and there is no suitability determination performed at the account level. Suitability determinations must be conducted at the account level, and there is no exemption from this requirement. However, firms may choose to perform supplementary suitability determination at the household level for clients who want it. You can find more guidance in the CFR FAQ document dated December 6, 2023. Through our reviews, we found that some registrants are not including all the necessary information in the investment management agreements that they sign with their clients. Specifically, we found that the investment management agreements did not include the method and timing for terminating the agreement and did not disclose how the client's personal information will remain confidential. For PMs and IFMs of prospectus exempt funds, we found that the offering memorandum did not include sufficient risk disclosure and in some cases contained inaccurate information about the fund, such as about how management fees are calculated, what types of fees are charged to the fund, and what risks are relevant to the investment fund's portfolio. Registrants should ensure that the clients are aware of material relevant information associated with their investment product, and that information presented to subscribers is accurate, clear, and understandable. Other recent findings we have identified for relationship disclosure information include registrants that hold their client assets at a third-party custodian must disclose the location where and a general description of the manner in which the client assets are held and provide a description of the risks and benefits to the client arising from the assets being held at that location and in that manner. However, we found that some registrants are not disclosing any or all of this information to their clients. Some registrants are not providing a description of the limits on the products and services the firm will offer to the clients. Specifically, we found that some registrants are not disclosing that the firm only offers their own proprietary funds to the client, or that the registrant's product shelf is limited to certain products. For example, a firm that can only offer ETFs or mutual funds to the client due to providing no-call, robo-advice, portfolio management. For disclosures related to conflicts of interest, we will talk about this in the next slide. Some registrants are not providing all the required disclosures to the client about their obligations if the client has a complaint, and all the steps that the client must take in order for an independent dispute resolution or mediation service to be made available to the client at their expense. More specifically, firms were not disclosing the time limitations a client has for escalating a complaint to OPSI. CSA Staff Notice 31338 includes a sample disclosure for complaints that provides clear and meaningful disclosures to clients. In our reviews, we found that registrants are not explaining how the KYC information that they collect is used in the suitability determinations, or providing a description of the various terms such as risk profile and investment time horizon. Some registrants are not providing a description of the circumstances under which the firm might disclose information about the client or the client's account to a trusted contact person. Some registrants are not providing a general explanation of the circumstances under which the firm or one of its registered individuals may place a temporary hold on a client account, and did not provide a description of the notice that would be given to the client if a temporary hold applicable to the account is placed or continued. Lastly, during our reviews, we found that some firms made significant changes to the relationship disclosure information documents. However, the updated relationship disclosure information was not provided to their clients. Registrants are required to take reasonable steps to notify their clients of a change in a timely manner if there is a significant change in respect of the information previously delivered to the client. Now I will pass this time to Claudine as she will present the remaining slides.
Thanks, Ashley. I will now continue our presentation on conflicts of interest. Okay, so the CFR amendments for conflicts of interest came into effect on June 30th, 2021, and we're still finding registrants only addressing material conflicts of interest with disclosure or client consent alone. Registrants must address conflicts of interest by either avoiding those conflicts or by using controls. We also observed conflicts of interest arising from proprietary products being addressed by only satisfying the firm's suitability obligation. Completing a suitability determination without taking any other steps is not an adequate control to address this conflict. The requirement to put the client's interest first in suitability determinations is separate from the requirement to address material conflicts of interest in the client's best interest. Registrants should have already complied with their obligations to address material conflicts before they consider taking any investment action for a client. Registrants must address this conflict by having adequate controls in place, for example, by establishing a robust KYP process for the proprietary product and evaluating whether proprietary products are competitive with the alternatives available in the market. Registrants are also required to provide disclosures to clients. During our reviews, we also found that some registrants failed to identify certain conflicts of interest as material, or the registrants failed to identify the conflicts of interest at all. For instance, some registrants failed to identify the material conflict of interest arising from when fees charged to similar clients are different. There may be a material conflict of interest or a breach of the client's duty to treat clients fairly, honestly, and in good faith if a client is being charged more than other clients for the same or substantially similar products or services. In these cases, we expect firms to determine and disclose to their clients clear criteria on how they calculate fees. Essentially, if fees are based on the size or type of the account, or the types of the products being provided to the client, and so on. If a firm does not have a standard fee schedule and fees are negotiated with each client, then this should also be disclosed. Also, some registrants fail to identify the conflict of interest related to referral arrangements. Paid referral arrangements, whether they are referrals into the firm or referrals of the firm's clients out to another entity, are inherent conflicts of interest that are almost always material and should be addressed in the client's best interest. The payment of a referral fee to obtain a client or the receipt of a referral fee to refer a client can influence a registrant to put their own interests ahead of their client's interests. In addition, although firms will typically pay a referral fee to acquire new clients, for example, by paying a portion of their management fee to the referral agent, those referred clients should not be charged higher fees than similar clients who have not been referred. Some registrants also failed to identify the material conflict of interest inherent in performing in-house NAV calculations for prospectus exempt investment funds. When management fees are based on the fund's NAV, a registrant could be motivated to increase and smooth out its NAV calculations because it will result in higher management fee being charged and the fund's performance appearing to be less volatile. We also found some registrants are not providing adequate conflicts of interest disclosure to their clients, or in some cases, the registrants did not provide any conflicts of interest disclosure at all. Registrants are required to disclose in writing all the material conflicts of interest identified to a client whose clients are affected by the conflict. The disclosures must include a description of the nature and extent of the conflict, the potential impact on and risk that the conflict could pose to the client, and how the conflict of interest has been or will be addressed. In our reviews, we found it was common for firms to disclose the existence of a conflict, but they did not disclose how the conflict could impact the client and what risks it created, and some firms also did not disclose how they had addressed the conflict. Also, registrants must document their identification, review, and analysis of the conflicts of interest, their determination as to whether a conflict is material, and the controls used by the firm to ensure that these conflicts are addressed in the client's best interest. Lastly, we found some instances when PMs failed to obtain specific client consent to proceed with managed account discretionary trades to purchase securities where a responsible person of the PM, such as the advising rep, a partner, officer, or a director of the registrant or an affiliate, was a partner, officer, or director of the security being purchased. In some cases, these PMs had provided high-level disclosure of these potential transactions in their RDI, such as by disclosing that the PM may invest in related party issuers, but without disclosing any specific information about the issuer or the nature of the relationship between the registrant and the issuer, then this is insufficient, as clients are required to provide specific consent to each purchase of an issuer, which includes the client receiving adequate disclosure of the relevant facts prior to giving their consent to the transaction. Next is client reporting. During our reviews, we found that some registrants are not including all the information required in the account statements, additional statements, report on charges and other compensation, and investment performance reports. Further, in some instances, the registrants failed to provide a report on charges and other compensation and investment performance reports to clients. For each 12-month period, registrants are required to provide these annual reports to clients. We also found that some registrants are only providing the account statement or additional statement to the client at the household level and not for each client account. There is no provision for consolidated account and additional statements, so registrants are required to provide every client with an applicable statement for each of their accounts. Registrants may choose to provide supplementary reporting at the household level to the clients who want it, but only as a supplemental information, as there is no exemption from account level reporting for quarterly or monthly statements. Further, some registrants are also only providing the annual report for investment performance and charges and other compensation to their clients at the household level. Registrants are required to provide separate annual reports for each account of the client, or they can provide consolidated annual reports for each client if the client has provided written consent to consolidate their accounts into a single report, and that the consolidated report also specifies the account covered in the reporting. Registrants may also provide consolidated annual reports for multiple clients, such as family group or a household, but only as a supplemental report. Okay, on to marketing. In our reviews, we found some marketing materials that were misleading and inadequate because, first, they included statements that are unsubstantiated, unbalanced, or exaggerated. For example, we found statements that would say that the registrant always offers the right strategy, or the registrant service is more competitive than the market. Without any evidence or backup to support these statements, these would be unsubstantiated and exaggerated. We also found marketing materials which disclosed misleading performance of prospectus exempt investment funds by using an internally calculated adjusted net asset value figure, which was different from the unadjusted IFRS-based NAV pricing used for investor redemptions. For example, the firm calculated the NAV using IFRS standards and then adjusted the figure. These resulted in the marketing material showing an inflated and smoothed out performance versus the more volatile NAV figures calculated using IFRS accounting standards. We also found general statements claiming that non-publicly traded securities will improve returns and reduce portfolio volatility. This would be unbalanced without also discussing that prospectus exempt securities carry greater risks and have limited or no immediate liquidity. Second, the marketing materials contained performance return data that did not disclose the time period. When presenting performance return data, registrants are expected to date the period presented and provide adequate disclaimers regarding past performance as appropriate. Third, the marketing materials do not disclose the source of information for third-party information. When there is third-party information presented, Registrants are expected to disclose the source of the information if it's not obtained from publicly recognized financial and statistical reporting services such as stock market or economic indices. Lastly, the marketing materials include information about investment activities and performance returns of institutional investors, which was presented without adequate disclosures of the significant differences between most institutional investors and individual investors in regard to their financial circumstances, investment objectives, time horizon, risk tolerance, liquidity needs, and knowledge. These differences may enable institutional investors to take different risks in their investment portfolios compared to individual investors. This may also give institutional investors the ability to negotiate advantageous pricing and deal structures. Through our reviews, we found that there were unregistered persons or companies holding themselves out as registered based on claims and statements made on their website. For example, by stating or implying that these individuals offered to provide portfolio or investment advice to clients. This is misleading and confusing because it may appear to investors that they are dealing with a registered person or company. In our reviews, we also found unregistered referral agent companies who hosted white-labeled client-facing onboarding systems managed by the PM for collecting KYC information from clients, but which did not clearly explain to clients that they were clients of the PM when using these services, thus giving the impression that the PM services were being provided by the referral agent. We also found that some registrants did not use their full legal name or registered business or trade name when conducting registrable activities. This is misleading and confusing to investors because it isn't clear who they are dealing with. Without adequate disclosures, it may not be clear to investors who the registered entity is that they're clients of. Further, we also want to mention that when a registered firm uses a business or a trade name, they are required to notify the ASC or the applicable regulator of its use. Lastly, some registered individuals use corporate officer titles such as director or vice president when they're not officially appointed by the sponsoring firm to that corporate office pursuant to applicable corporate law. Since the CFRs came into effect in 2021, these types of corporate titles cannot be used by client-facing registered individuals who are not appointed corporate officers, unless exemptive relief is obtained for specific situations, such as when the individual only deals with institutional clients. For policies and procedures, we identified in many of our recent reviews that registrants did not have adequate policies and procedures in their manual related to various areas of their operation, including registrants that did not have policies and procedures at all in the PPM for specific activities that they were conducting, such as referral arrangements. Further, we are still finding some registrants that have not updated their policies and procedures to include the CFR amendments to 31103, specifically the policies relating to KYC, KYP, suitability, and conflicts of interest. Lastly, in our reviews, we found that some registrants appear to be using a template for their policies and procedures without updating or tailoring the policies and procedures to their business or operations. As a result, these policies and procedures are not reflective of what the firm actually does, and in many cases are not even applicable to their business model. For example, if a sole PM managing separately managed accounts has policies and procedures related to IFM functions such as fund accounting. Referral arrangements. During our recent reviews, we found that some registrants did not have adequate referral arrangements in place. Specifically, we found that their agreements did not include the roles and responsibilities of each party, the limitations on any activities that can be performed by any party that's not a registrant, the disclosure to be provided to the referred clients, and who provides the disclosure to the referred clients. In some cases, firms had entered into informal referral arrangements, which are still considered to be referral arrangements under 31103, because the registrant or the referral agent receives non-monetary benefits. These firms had not considered the compliance requirements of such arrangements or had not entered into agreements. Lastly, we found instances when referral arrangements were not dated or signed by a representative of the firm. The agreement should be dated and signed to ensure that registrants and referral agents are clearly aware of the arrangement they have entered into, and so the registered firm can adequately supervise their representatives and monitor their compliance with the agreements. Next is insurance. In recent reviews, we found that some registrants did not meet the insurance requirements in 31103, and that the insurance policy did not provide for a double aggregate limit or a full range statement of coverage. PMs that hold or have access to client assets are required to maintain bonding and insurance in an amount that's highest of the different formulas in 31103. Generally, a PM firm in this situation is required to obtain insurance covering at least 1% of their assets under management. We also found some changes to our registrant's insurance policy that were not communicated to the ASC. Registrants must notify their principal regulator in writing of any change in, claims made under, or cancellation of any bonding or insurance. The last thing we will talk about today is fund and trust accounting. During our recent reviews of IFMs, we found that some registrants include certain adjustments to NAV that are not in line with IFRS accounting standards in determining a fund's NAV. They were also not able to provide any written documentations or calculations to support the NAV determination and how the NAV they calculated is representative of the fair value of the fund's assets and liabilities in all relevant circumstances. While IFMs managing prospectus exempt investment funds are not subject to 81106, ASC staff consider that Part 14 of 81106 contains requirements applicable to reporting issuer investment funds, which can be used as guidance when setting out NAV calculation policies. These policies can be used to support how the IFM is acting in the best interest of the funds they manage and is meeting the specified standard of care in discharging its duties as IFM. We also found instances where general marketing and entertainment expenses of registrants, such as the cost of event tickets given to clients, were allocated and charged to the fund being managed, thus indirectly paying for them with investor assets. However, details of these expenses were not clearly disclosed in the fund's offering memorandum. Registrants earn a management fee paid by the funds to carry out their roles and responsibilities. Expenses related to a registrant's business activities should be covered by the management fee received or from the registrant's own financial resources. General expenses allocated to the fund should have a direct relationship to the daily operation of the funds and to be fair and reasonable to the funds. In addition, we found some inadequate procedures that registrants had followed for trust accounting. Specifically, first, the interest earned on omnibus trust accounts was recorded as revenue in the registrant's books. To clarify, an omnibus trust account was used to hold cash in transit relating to subscriptions and redemptions. Funds deposited in trust accounts are considered to be clients' money. And under 31103 custody requirements, these assets should remain separate and apart from the firm's own property at all times. Therefore, interest earned on omnibus trust accounts should be allocated to clients or investment funds and not recorded in the registrant's books as revenue, unless it's adequately disclosed to clients and charged as a fee. Second, wire fees charged by the bank on client redemptions were charged against the fund's trust account. This practice benefits redeeming unit holders at the expense of the remaining unit holders who are indirectly subsidizing the cost of redemptions. The applicable wire fees that can be directly attributed to any client should be paid by either the registrant or the redeeming unit holder. Finally, our recent reviews found instances where the IFM of a prospectus exempt investment fund had calculated management fees based on incomplete and inadequate portfolio valuation information. This did not incorporate recent valuation of assets held by the fund and just relied on the initial value of the asset at the time of purchase or funding of a mortgage loan. The use of stale NAV could result in management fees being higher than they should be and is contrary to the IFM's duty of care to the funds it manages. That concludes our presentation.